I acknowledge that I'm hosting this webinar from the lands of the Gadigal people of the Eora Nation. I also acknowledge the traditional custodians of the various lands on which you all work today and the Aboriginal Torres Strait Islander people participating in this webinar. Today's presenter is your host, Todd Gammel, Partner of Restructuring and Risk, Peter Bembrick, Partner, Tax Consulting, Donna Emsies, Director, Tax Consulting, and Rachel Freeman, Assistant Manager in Business Advisory. Now, without further ado, I'll hand it over to your host, Todd Gammel.
Thanks, Tanya. Welcome, everybody. I think today is about getting through a few of the issues that have arisen. I've got some personal issues coming through some of these. We're dealing some of these matters, and we've got the right type of mix of people from across our business who are dealing with these things on a day-to-day basis to give you some perspective and some practical issues around how to deal with them, and then somebody to talk to when you come across them yourselves, because there is a lot of things moving. There's obviously a change in the economy, the ATO position's changing, and there's movement in payroll taxes and other aspects where you just need to be across the detail again to be able to help your clients. So we're very fortunate. Peter, Donna and Rachel all have great experience. So we're going to move into those aspects very quickly and move into each of those aspects so that you can understand them. Please ask questions. I will be, because I get to be the non-tax person, the non-advisory and personal and family advisor. And I have a few questions around a couple of these things. So I'm looking to get some free advice as well while we're doing it. So please get involved. Some of it is interesting, some of it is just what we just need to be aware of, and we'll get going. So first up, fortunately we have Donna to talk about everybody's favourite issues, including across what the ATO is doing and some of those multinational issues which are a little bit more unique and things that you hit some of the time rather than all the time. Take it away, Donna.
Thanks, Todd, for that introduction. Good morning, everyone. Before I start, just to let you know, I'll probably be a bit higher level this morning. I did do a multinationals webinar last week, which we will share with the community, which is much more in depth. So Tanya will be sharing those webinar recordings and the slides if you're interested. But just first up, I guess I wanted to give a bit of an update on the ATO's focus area, which is a bit timely on the back of quite a lot of guidance aimed at multinationals, I guess, in the last 12 to 24 months. And also we recently engaged with the ATO. We had a meeting with them where they kind of gave us some insights about in the multinational space where they would be focusing their time and efforts. So late last year, we had a meeting with the ATO, and they let us know that there's a medium public and multinational business engagement program, which is really, I guess, focused on those economic groups with turnover less than 250 million in Australia. They call them a medium public multinational business. And there's been a bit of a change. So a change from their one-to-many type programs to now more of a, I guess, more focused one-to-one type engagements, and these are to treat risk arrangements that are concerning them. And this is on the back of additional tax avoidance task force funding that they've received over the next 4 years. And some of the areas that they've mentioned are concerning them include, the use of some small and medium business concessions. So applying those concessions even though the aggregated turnover thresholds might be exceeded. Also, a big one is the remittance of withholding tax, whether it's in relation to interest or royalty payments. The other one was cross-border transactions, including transfer pricing. So they're really, I guess, concerned with those related party financing arrangements and inbound distribution arrangements, and also hybrid mismatch. So hybrid mismatch has been around since about 2019. And that is where you will have, a bit of arbitrage between the differing tax systems between two different countries, and then entities in Australia either getting a deduction for something, but then that income not being included offshore. So, it's being deducted here, but not being assessed in another country. And so they consider those a bit of a risk.
And
So that's the
Donna,
main focus. Yeah.
and Donna, I've seen a couple of these things where overseas entities have decided to shut down local business because it's just become too complicated at an accounting level. Is that
Yeah,
one of the things we're
absolutely.
starting to see? Because unless they get the right sort of structure when they're coming in, some of these things can just make it very, very inhibitive.
Yeah, I mean, that is something that I have seen a little bit of, especially where, you might have a large global group and the Australian presence is really only quite small. But because of the administrative burden with, I guess, all of these measures it takes, and, for some of these as well, like with the multinationals, if they're an SGE where the penalties can be quite substantial, then that could be a deterrent from doing business in Australia.
But it just needs to be structured properly, as with everything.
Yeah, absolutely. And, it will require working with your global group head of tax to make sure that your arrangements here in Australia are, in line with what the ATO expect. And the ATO follows, generally speaking, they follow the OECD guidelines. But what we'll find is that Australia usually are more involved than other countries. Okay, so just a quick one on this. The ATO has released some updated guidance in relation to software royalties and withholding tax. The tax ruling is still in draft, but the proposed date of effect is already in place. So effectively it removes the old tax ruling TR 9312. And so really, if you've got any kind of software type arrangements, any intangibles, you really should be looking at this ruling, because even though it hasn't been finalised, it's currently in place. So just a recap on royalties. So royalties withholding tax applies to any payments of royalties by an Australian resident to a non-resident. So these usually come in when you've got the use of IP, or, for example, royalties in Australia is the definition, our domestic definition is quite broad. So it can include other things like know-how, the use of some quite complex machinery or equipment. And so therefore you've got to look at both the domestic definition as well as any relevant DTAs about what would be included in royalty. Usually generally speaking, the DTA definition will, take precedence over the domestic definition. So the Australian entity paying for the royalty amount has the obligation to withhold and remit that royalty withholding tax to the ATO. If there's no DTA in place and the royalty percentage hasn't changed, then it's a 30% withholding rate. But if there is a DTA, it can go down to as little as 5 or 0%. And if you fail to withhold the royalty withholding tax, and you've got an expense, so you've made a payment, you actually can't claim that until you have withheld and remitted the royalty withholding tax to the ATO. So just make sure, that's one that we find can be a bit of a sleeper. The other thing to note with royalties withholding tax and also interest withholding tax should be more accurate is that these withholding tax obligations don't have any period of review, in the sense of there's no limitation on.
So there's no statute.
No,
Yeah.
so 2 years, 4 years, that doesn't matter with these type of obligations. It could be 10 years, and the ATO can come back and make an assessment in relation to the withholding tax.
So is this a sleeper sort of story where this could be something, if they decide to go through and do audits, that this could be a, let's not say revenue raising sort of approach, but it could be a way that they go back and do that, and particularly with some of the larger entities that may not have thought this, or some of the smaller entities which have just been oblivious to having to think about it.
Yeah, absolutely. And it will depend obviously on the quantum, you know, so the ATO, like any other organisation, will do a risk assessment. What's the cost of them going into audit for X number of years versus what they can claw back? But it is something that, you know, if you do have clients that are doing multinational type business, they're dealing international, they've got, you know, international related party dealings, that royalty withholding tax or interest withholding tax is really important to be across for your clients.
It feels like an edge issue around all of these things where the government's talking about making sure that everybody operating in Australia pays the right amount of tax. It sounds like another way around the edges they could get there.
This is coming, the ATO have just recently won a federal court case, the PepsiCo case, and this has come about in that case as well. So just high level, in on a little secret, I'm not a lawyer, so I'm not going to go through all of this as a lawyer, but I guess the ATO have recently received that federal court ruling in their favour around royalties and PepsiCo. So this has given them, I guess, a bit of traction and impetus to be able to do more of these type of audits. Mind you, this case is up for appeal, so you know some things may change, but for the time being, they do have this win under their belt. In this case, PepsiCo, which is, you know, a drinks company over in the US, it had an arrangement with a third party in Australia called Schweppes or Sapple, and the crux of this case is that in the contract, the exclusive bottling agreement, it did give rights to Schweppes Australia for the use of IP, the brand name, etc., but it didn't provide any detail around how much or what consideration would be involved for that use of IP. The contract only really spoke about providing a concentrate. So, you know, PepsiCo would provide the secret ingredients, the concentrate to make Pepsi, and that would be provided by this PepsiCo PBS Australia. So also in that contract, it allowed PepsiCo US to nominate who the seller would be. And so a few of the issues in this case that are really interesting is that even though Schweppes Australia is paying an Australian entity for the concentrate, because it was the nominated seller in this case, the ATO have successfully argued that that payment was included in that payment was an embedded royalty, which is, you know, a component of it was for the concentrate, but a component was also for the use of the IP. And even though it was paid to another entity onshore, it wasn't even paid offshore. The ATO successfully argued that that was a royalty payment subject to royalty withholding tax. So that is quite interesting for this case. So just a little bit of a recap on some of the facts. Yeah, so the contract was solely for the use of the concentrate, and the seller would be nominated by PepsiCo, which, you know, by their direction, they said that it would be an entity in Australia, so they were taken to have derived that income. And the ATO were successful in arguing that there was an embedded royalty in that payment. The case also went into a lot of detail around, well, you know, you've got, say, $10 payment for the concentrate, how much of that, you know, should be attributed to the use of the IP, and the what the court ended up ruling is that 5.88% of the sales related to the use of the IP.
Sounds like a big experts report that got to that number.
Yeah, there were quite a few independent experts reports, you know, doing the valuation of that IP and what the royalty withholding tax would apply to. So, you know, that was just recently handed down. As I mentioned, you know, it's still up for appeal. But this is, I guess, where, and then the ATO currently also have another case on foot with Coca-Cola along the same lines. So once they've got these big test cases under their belts, then they're much more, I guess, equipped to go around and you know, conduct the smaller audits once they've got these type of decisions to support them.
And if they get a breakdown similar in the Coke case about that 5.88 or 6% or something like that, they might actually give a ruling or a guidance of what their view of it is for other parties to be able to apply, because there's obviously a few drink suppliers and things like that that'd be similar.
I don't think they would, to be
No?
honest. I think it's, it's
Case
very
by case.
hard to value intangible assets, and so it would be something I think that people would need to do to value the different. Is it just the brand that's being provided? Is it other know-how? Is it equipment? I don't think it'd be an easy exercise for the ATO to just provide that type of guidance.
So they'll go the other way and they'll ask, everybody will probably try to have to then break it up in the contract to be able to specify which portion is which, so that it's a bit clearer.
Yeah, it'd be really important that if you have any use of IP, that you would have a specified agreement, and you could do the valuation or the analysis and then work out what component of the payment would be in relation to that. And it's probably best to do that, because if you lump in all of your services and purchases and everything together, then you potentially could if you don't dissect it and the review goes bad, you might end up having withholding tax on a greater amount than you need to. So it's probably better to do that analysis yourself and structure those arrangements so that you can see exactly what each contract is related to.
I think it's fair to say, Donna, isn't it, that the ATO uses these sort of decisions to apply them as broadly as possible. So hence why they're not going to get too specific. So there's like I think you were saying, they're establishing a principle, but then they can apply in lots of situations.
Yeah, so I think there's two things in this case in particular. One is about the embedded royalty. And then the second one is about that, the direction. So by their direction, they were seen to have derived that income. And even though it was an entity onshore, the withholding tax still applied. So, yeah, I mean, it's those two things which I think in this case, to my mind, were the most interesting things. And we'll see with the Coca-Cola case as well, whether they've got successful application of the principles more broadly. So just last thing, with our discussion with the ATO, so I mentioned, that the ATO had a few different hit areas around the use of small business entity type concessions, as well as the withholding tax obligations and cross-border transactions, etc. What I thought I'd show here is some of the disclosures that you'll be entering for your clients, and I guess where those kind of issues will show up in the tax returns. So if you've got small business concessions, they'll show up in the tax returns under your base rate entity disclosures, your SBE concessions, temporary full expensing or instant asset write-off, loss carryback, etc. Whether or not you're remitting the withholding tax, that'll show up in both the tax return and your international dealing schedule, the IDS. And some of these cross-border transactions, including transfer pricing disclosures, will come through in the IDS, as well as your reportable tax position, if you've got an obligation to lodge one of those, as well as country by country reporting. So this is something I didn't mention, but it's in the webinar last week. So if you've got significant global entities, that's global groups with a turnover of greater than $1 billion, there's a lot of obligations for them that kick in around disclosures and reporting, and also increased penalties. So it's really important to understand, I guess, if your clients are SGEs or not. If you've got a client that's owned offshore, it's got a foreign parent, it's really important to clarify the global structure and what the turnover is, to make sure that they're not an SGE, because otherwise you've got a whole lot of obligations that you have to deal with. And then the last thing was the IDS under Part G will include all of the hybrid mismatch type disclosures. Something I just wanted to raise quickly before I pass across to the next person, which I think is Rachel, is that with the hybrid mismatch, if you do end up having a hybrid mismatch, it does require you to make a tax adjustment, and if you can't prove that there isn't a hybrid mismatch, it's probably better practice to deny the deduction until you do have the proof. But what we're seeing now is that some of these, if you're not careful, some of these hybrid mismatches, if you've got material international related party dealings in that group, they also may be material adjustments for audit purposes. So just make sure that you're considering that if you've got any clients that are being audited. So that's kind of like front ending this work for the year. So I think that's about it from me.
So the good and the bad thing is the ATO is creating more opportunities for tax advisory services. The bad thing is it's just a little bit more complex, that you've got to get your clients across it so that they can understand it and then see the need to engage your accountant to be able to do it.
Yeah, it's a bit of a life cycle, right? So these measures come through, we've got to get across them, we've got to educate the clients, they've got to educate their head of tax or their global groups why Australia's asking for all this stuff. And then we've got to work together to try and get as much of that disclosures or the analysis done before we actually need to report them in your tax returns or otherwise.
Okay. Thanks, Donna. Handing over
Thanks.
to Rachel, personal services income update, something close to everyone's heart on this call, I'm sure. Please tell us, Rachel, how well they're going and what we can do to try and manage it.
Morning, everyone, and thanks for the introduction, Todd. So yes, personal services income, I'm sure you've dealt with this in one way or another with all of your clients. And so the reason why I wanted to focus on it today is there was a ruling released in November 22 from the ATO, and largely the principles are the same from the previous withdrawn rulings, but there's been cases over the years where the ATO has expressed their view on when particularly personal service business tests are met, and this new ruling gives guidance and clarifies and makes it quite clear how the ATO views certain tests, and has built in a lot of those cases that have been topical into the ruling. So I won't go into heaps of detail on the actual rules itself, as I'm sure you're all quite familiar with it. I'd like to mostly focus on some examples, because I found the examples in the ruling to be quite easy to understand, and there's a few points in there which I think are worth noting, especially with clients relying on some of these cases to self-assess as a personal services business. So just as a bit of a refresher, the PSI income rules, they're intended to ensure that individuals who are performing the personal services are actually taxed on this income if certain conditions are satisfied, and they also act to limit the deductions that would not have otherwise been available if they were taxed in their own name. So when you enter the PSI rules, it's relating to income that's mainly a reward for personal efforts, skills and expertise. And then once you enter this, you need to self-assess as a personal services business in order for the income not to be attributed to the relevant test individual. And then otherwise, if you don't meet those tests, you can apply for a personal services business determination, but that can only really be applied if there's quite unusual circumstances as to why you didn't meet those tests. So yeah, just to kind of whip through the tests, as I'm sure you've all familiar with them, but the first one being that was the income mainly derived from achieving a result. So there's various conditions to meet the results test, such as providing the plant and equipment and the tools, and also being responsible for any defects. So if you don't meet that test, then you go on to the next rule, which must be satisfied, the 80% rule. So no more than 80% of the personal services income can be from one client or an associate. So once you meet that test, then you must meet one of the other three tests, being the unrelated clients, the employment, or the business premises test. So I won't go into detail on those, but I will touch on them when I'm going through the ruling. And so this ruling was released in November 22. It is retrospective. And so the 2023 financial year, which I'm sure all of you guys are quite smashed with at the moment. I know we are. Upcoming 31 March and 15th of May deadline. This is really the full financial year where the updated guidance was released and should be referred to when we're determining whether we're comfortable with self-assessing as a personal services business. In the tax ruling that was released, there was a few standouts, particularly the unrelated clients test and the business premises test. So I'll go into those. They do build in, there's actually 41 examples in the ruling, which are aimed at providing guidance to the taxpayer to better their decision-making on whether they actually do satisfy the tests, and particularly there are a few cases that they've built into those examples. So with the unrelated clients test, in my experience, this is one that clients frequently rely on. So more than 2 clients cannot be unrelated to meet this test, and they must be as a result of a direct public offer or invitation to the public or a section of the public. So to meet this test, the tax ruling makes it very crystal clear that you need to win the work through the public offer or invitation. So it's not enough to just have a LinkedIn profile, which is more used to add credibility or have, client testimonials. You need to be able to demonstrate that there's a direct cause between you making the offer and accepting the offer and relating to the current year PSI income. It also makes quite clear that if you're using labour hire firms or recruitment sites in a kind of intermediary to be able to win these opportunities, that does not meet the condition of making an offer to the public. So that's a bit of a pivot. Well, not a pivot, but that's quite a big thing to come out of it. There was a...
So Rachel, you've got to do this effectively old school. You've got to respond to an ad in the paper or a sort of government contract request, or it is going backwards. It's an analog approach almost.
Yeah, it's going back to a lot of the traditional advertising. It makes it quite hard to meet this test. You really need to have like a revenue generating website or, be applying for public tenders to be able to meet this test. So it's definitely making it quite hard for people who typically win work through word of mouth. That is, very difficult to argue that meets this test.
The ATO are familiar with digital marketing. Is they just don't like it yet, or are they?
They're definitely closing the avenues where you can satisfy this test for your typical consultants. And it's some of the examples they give, like print advertising and radio. I just wonder how many, people really work through that to be able to meet this test.
To your listeners.
Yes, that's right. Yeah, and look, that's not to say that you can't meet this test through a social media platform, but typically people use it to advertise themselves, not so much make an offer to the public, section of the public. And the word of mouth referral, that one, has come up before in a few cases since the original tax rulings were released. So there was an example, I think it was example 26 in the ruling, where the facts almost match exactly a case, the Yalos case, which is basically, so Yalos is an engineer, undersea diver of offshore oil rigs, and he actually was able to meet the unrelated clients test because he argued that he had a very small number of potential clients, and the skill was highly specialised. So that in that instance, the word of mouth referral, the ATO was satisfied with that, but the the facts in the tax ruling are really focusing on the very small number of potential clients, not so much that the fact it's a specialised skill. So actually we have a client who submitted a personal services business determination. They were going through issues due to COVID and having to relocate, so they didn't meet the 80% test and the unrelated clients test in those years. And the ATO came, so actually just for some background, I was a management consultant. He used to consult with Woolies and very like specialised roles that they didn't offer to the public. However, the ATO actually came back and denied it because they said, well, for one, economic downturn and that's affecting the whole industry is not unusual. So they weren't satisfied with that. And they also said, well, you're relying on the Yalos case because you have a specialised skill. However, you have a very large number of clients, large manufacturers there. There's plenty, so that they were not essentially able to rely on that case. So they've made that quite clear in the new ruling. So the unrelated clients test, bring it back to what's relevant for us as tax advisors. It is becoming quite hard to meet that test. It doesn't necessarily block you from the other tests. It just might mean that, yeah, if your client does not have a revenue generating website or making public offers to which have 2 or more clients, one through that, then it is becoming quite difficult to use that test. And with so just moving on, the employment test, it's largely consistent with previous rulings, so I won't spend much time on it. However, there's quite useful guidance on determining the market value for single and multiple contracts. So the employment test, just as a recap, is if 20% or more of the principal work is performed by employees or contractor arrangements, then you can you apply that test for that test individual. So those examples are quite useful, and also it makes it quite clear that if you have employees performing non-principal work, and they gave some examples, preparing invoicing, admin tasks, even budgeting, there was an example that is not integral to the actual principal work, and so that doesn't necessarily count. So if you have, clients who have their daughter on the books or their wife on the books doing some accounting services or bookkeeping, then they make it quite clear in that ruling that that's not gonna meet it. So moving on to the business premises test, I actually found this one as well to be quite a standout in the ruling. So in order to meet this, you must perform the personal income services at a business premises at all times while you're performing those activities, and also you must have exclusive use of the business premises, and it must be in a separate location. To say if you have a home office, that won't meet that test. So the main standout for me from this test was, you would pass it to have exclusive use. I'd say that is the term that the ATO have focused on quite a bit and what that means. So if you own the property or you lease it in your own name, then you have the legal ability to solely use the premises, and for other people not to also have the right to be able to use the premises. So that meets the exclusive use aspect of this test. However, joint leases and license arrangements and subleasing, the tax ruling outlines that these would rarely meet the test of exclusive use, because essentially, like, if you're not working in that space, then they can allow someone else to use that space. So I think about it like in terms of an accounting firm. If you have a consultant that comes in and advises on, say, like GST, even though he might have a meeting room he can use that he subleases, we can use that meeting room when he's not there. So that does not meet the exclusive use test.
So they've effectively closed that, like, unless you've got your own lease or you own your own premises for business purposes only, you don't qualify.
That's right. Yeah. And it can't just be a lease in name. You have to demonstrate that you're actually performing the personal services income in that premises.
So they're trying to push you back to the other two tests, really, to make sure that you're adhering with those two. You can't get through this trapdoor.
Yes, I mean, it is a self-assessed test, and I believe, you know, from their experience in reviewing clients, these two avenues are frequently used to say, oh, you know, I rent this, and there's lots of different new age apps where you can, services where you might rent a space for a few days a week and then it's used by someone else in the other days, and they're really trying to close those avenues and stop taxpayers relying on it. So they're saying, hey, this is the renewed guidance, this is where we stand on it. You cannot rely on other cases which might be quite specific to those set of facts. So, I mean, look, if you have a client that is subleasing, it might be time to think about whether they can lease their own property if the income is of a substantial size. But yes, those joint leases and licensing arrangements are definitely problematic. You'd want to be reviewing the contracts, and based on the tax ruling, it seems very unlikely that, because of the legal nature of those arrangements, that it wouldn't be considered to have exclusive use.
Okay.
So that was really the main things I wanted to cover. I think from our point of view, we should be having those conversations with clients and making them aware of the risks of having this income attributed in their own name, and maybe reviewing the arrangements that we've just been considering, same as last year. I think we should really be opening this up and letting clients know that the ATO's view on it.
Another opportunity to see if there's some advice to be given there to structure things better if this is a critical issue for people coming forward. None of us like paying 47.5 and beyond tax rates. All right, Kerry Packer rule still applies. Thanks, Rachel. We'll move on to Peter, and Peter's going to tell us all about the landholder and land tax, another wonderful tax update, and then some payroll tax stuff where I'm going to throw some curveballs at him as well.
Yep, look forward to that, Todd. Thanks for that. Thanks for the introduction. Yeah, again, thanks everyone for that's dialed in. I know definitely know a few of the names on the list there. So good to see you all coming in to so our valued HLB community members. So yeah, I wouldn't say state taxes is my favourite area, but I don't think it's anyone's favourite area particularly. But these are all things that, yeah, we need to know about. So I thought I'd start with, I've just got a couple of slides. So I'll start with landholder duty and land tax issues, which, again, these are all big areas. I'll get onto payroll tax, which sort of probably links into a little bit of what Rachel's been discussing in the same sort of area in a way. And it's all things we need to consider. But as far as landholder duty, I mean, this is pretty simple in that these are legislative announcements, the changes that have been made to the tests, which are just very current, so we just need to be aware of them. So firstly, so transfers on after 1 February. So we're now, some of the stuff we've been saying is opportunities to get in before 1 February. Well, that's passed now. So this is reality that we need to deal with. A significant change. The first one's a significant change when you're dealing with private unit trusts in landholder duty, and I'm sure everyone's got the broad understanding of landholder duty that you know, you obviously you transfer property, you have duty when you're transferring entities that are landholders, then duty, and that's where we see a fair bit. So I'm sure you all do as well, where you've got to really be quite careful with how you manage those transactions when there are a bit of sort of structures owning property. but this one with the unit, obviously unit trusts are a very common way to acquire property, whether for development or for investment, sort of, particularly when you've got multiple parties coming together. I know that Rachel, we've got a couple of clients that are particularly involved in doing sort of transactions where they go in with other parties. So again, unit trusts, very common structure. The fact that we could have different rules for public. I'm focused on private on the basis that that's probably what most of us are dealing with. So the fact that a private unit trust could, the threshold used to be 50%. So if someone had less than 50% interest in a private, and that was not was regarded as significant interest for landholder duty purposes, so transferring 20, 30%. Or acquiring 30% of a unit trust that in turn owned land wasn't a significant interest, so didn't necessarily attract landholder duty unless you get to that 50% level. So now the government, our wonderful state government, has reduced that to 20%. So that's obviously opens up a lot more transactions to potentially landholder duty, and just needs a lot more planning. And we might have structures already in place, but certainly if we're looking at new transactions. Be aware of that threshold is reduced, and that's going to require a lot more planning of when we're looking at things, because 20% is a pretty easy threshold to meet. You have to have a lot more late owners. So, and the related one is linked entity so structures. So where you've got larger structures or more complex structures with different linked entities, and that this would be an entity, could be a trust or a company. And I'm not going to go into too much detail, but if there's any particular questions or exposure to it, we can discuss that. But again, that threshold was 50% and has been reduced to 20%. So again, you think about a structure, the more complex that's the structure, there might be only an underlying interest of 20% in a land holding entity, it's a company or a trust, and that can then be sort of included, so transferring shares further up the line or interest further up the line can lead to landholder duty issues. So again, just being aware of those thresholds so you can advise your clients appropriately and plan. And it may not be there may not be an easy solution when the threshold's only 20%, but land duty is not a cheap tax, so you've got to try and plan it as much as possible, and certainly you don't want to have double duty. So if you're doing multiple transactions, at least only if you have to pay it, only pay it once. And then also noting the aggregation rules. And this can get quite complex, but it might just be a one-off transaction. A small acquisition can also cause the threshold to be exceeded, and almost some of what I was reading, you need to really get into the technical detail of it, but it talks about within a particular period. So, but certainly you could have a 5% acquisition, which causes you to go over the 20% interest or the 50% interest, and it would the whole lot could be potentially attract duty. So there's a lot of traps in this area, and just something that you need to be aware of and think about when you're advising clients on particular transactions.
Pete, we see it as an issue that's going to be a sleeper on restructuring as well.
Oh, totally. I'm sure you would do.
When you're moving around things and you're changing debt structures and all of those type of things, this is going to be one of those things. The unintended consequences to impact that, add further costs and complexity.
Absolutely, yeah. And you would have to. You would have to do things like that, wouldn't you? You'd have no choice. So yeah, I'm sure you're going to have a lot of duty issues, and there's no really easy way around these things. But being aware, the first thing is awareness, and then seeing how you can minimise the impact. So that's all about landholder duty. Reconstruction, talk about restructures. Well, corporate reconstruction relief. People would be aware that when you've got corporate groups, there's that relief's always been useful, particularly if you plan it appropriately to do a restructure, whether it's for something like what Todd deals with, where you have to do it, or it's just what we're normally doing, where it's not actually an essential thing, but it's something where the client's looking at for various commercial reasons or family reasons or whatever. That if you're doing a restructure of a corporate group, the fact that there used to be 100% exemption if you did it right, and now it's only 90%. So it's again, depending on the numbers involved, that there's the fact that there's going to be a duty exposure where you could potentially avoid duty completely is a big change, something we need to be aware of.
And then, Pete, if you want to do it again, there is no relief, is there? You only get one crack at it. So if you're looking at it, if you do it as part of your process every now and then, as tax structures change or as your business changes and you need to move it, you only really get to do it once potentially. That's probably another.
That's a huge one.
Issue.
Yeah. So it needs a lot of planning. That's right. And at least it was some years since we at least we're dealing with and again a lot of it's with underlying, especially with underlying property. At least we don't have duty on business transfers now. It was sort of quite. We as our Australasian network, we talk to our colleagues in interstate, and we usually have a conference every year. It was quite illuminating when we had a catch up amongst the tax group last year, and particularly WA and Queensland. When I've advised also through an account, one of our community members who had a transaction going in Queensland, and you forget that we used to have duty on transferring goodwill, and if you're in Queensland or WA, you still do. So that's quite if you're dealing with interstate transactions, that's another area that's again a big trap, because Victoria hasn't had it for a long time. We followed suit, but other states haven't. So you got to be aware of that's the thing about state taxes. You have to be aware of differences between states if you are dealing with interstate rules.
And these issues, Pete, it's obviously been a great source of advisory work as well, but it's also been the way, at a commercial level, the way I look at it is that bridging the gap between a purchaser and a vendor on some of those transactions can be done by the tax structuring.
Yeah, absolutely. Yeah.
And if that starts to minimise or limit, it may well mean that the transactions may become more difficult, or concessions are going to need to be greater between those parties, rather than being able to apply the nous that a good tax advisor can bring to a transaction.
Well, when New South Wales finally abolished duty on business transfers, that was a real game changer. That made transactions so much easier. So anything, so you're right, anything that gives us duty issues to consider or whatever is, and so again, we're mainly dealing with when there's property involved in New South Wales, which I suppose again a lot of the matters you see, I'm sure Todd, do involve property. So that's it makes things very difficult. Yeah, absolutely. And the other big change on a different note. So I just stay with that slide for a minute, Tanya. Yeah. So the final point on that slide was about the principal place of residence exemption, and it's we used to deal with main residence when it comes to CGT, and principal residence for duty has its own rules, and the big change here is that there's now a 25% limit on so it used to be used to be able to have a smaller interest, so where you've got jointly owned. Sometimes we see, jointly owned property, and so one party has a smaller interest in the property. Yep. You could still, as long as it's then principal residence, you could still get the exemption. Now, 25%, again, increasing that threshold means that it's there's going to be transactions or situations that don't meet that requirement. So it's going to again make things a bit more difficult.
I assume that the banks don't qualify for that, otherwise they've got a big tax bill coming through shortly.
Well, sure, yeah, that's right. So. Yeah, no, we don't count the bank's interest, which I'm sure is pretty high in most cases. So that's all I wanted to say probably about that area, Tanya. Has anyone's got any questions? So I'll move on to payroll tax, and which again we're getting back into sort of the areas, a little bit into the space that that Rachel was talking about before. And just the whole employee, and again, there's so much you could say about payroll tax. So I'm only going to scratch the surface here on some more topical areas. And it links into the whole area around employee versus contractor, which is, again, it's been a hugely topical area, all the gig economy and just the different ways of doing business or people do operate. It's changing, and it keeps changing. It keeps changing. So, and you can talk about whether someone's an employee for income tax, PAYG purposes, super. There's been a lot of cases relating to super, but I'm going to focus on the payroll tax, which again is medical centres. We know that doctors and again, I'm not talking about income tax here, but the doctors, the ATO has their own approach to medical practitioners. But for some of these cases, they're mentioned, and the ATO has got a new ruling last year. And the general thrust, there's been some other cases interstate as well, but the OSR ruling there in 23, but with the Thomas and Nars and the Optical Superstore, again, the general thrust is to look at, you're all familiar with the medical centre, big medical centres where the doctor has a room, and usually there's a shared reception and other sort of facilities, and they go through various scenarios about, there's a bit of a spectrum. You could have the situation where someone is it is just a tenancy. The doctor just rents the room and does all their own admin. I don't know how many doctors actually do that, but theoretically that could happen, and there's no real sort of central admin and support. Then that would potentially still, not raise a payroll tax issue, but the OSR or the State Revenue New South Wales and other states, happening in Victoria as well, they're looking at where you're in a medical centre and you do have those shared services. Potentially there's just different arrangements. It could be the practice bills, and the doctor is just sort of getting their cut, but even if you're essentially being billed through the doctor, if there is all this central they don't have exclusive use of the room, but even if they do, if there's a lot of central support and reception and admin, which there usually is in most of these centres, then the Revenue New South Wales will be looking at to try and apply payroll tax. So actually, if you've got medical practitioners of various sorts, then this can be a significant issue for them. So and you go through a couple of the exemptions, again, we're covering the same sort of issues, providing services to the public. So a lot of medical practitioners do go to rooms at a practice. They also provide services through hospitals. They might, especially specialists, might go to a couple of different medical centres. So they're not as tied to one medical centre like probably a GP or some doctors might be. So that's one area where it is possible to have an exemption. So again, it's all very fact specific, but
it's a lot of complexity to your life, moving around huge, that 90 days a year, right? So you've got four jobs effectively.
That's right. So if you engage for less than 90 days a year, that's a specific exemption under payroll tax law. So that's possible if you've got services provided by 2 or 4 persons. So most doctors you see are operating on their own, but if you start seeing particularly specialists getting together and actually forming a practice that where they 2 or 3 or 4 specialists have an interest in the practice, and it's more of a practice as opposed to an individual doctor, then that becomes a whole different ball game. So that's certainly possible. But again, I think particularly with GPs, but also specialists, you'll see a lot of them where they're in a medical centre, and it's really they really start to look at it as like they're engaged by the medical centre virtually, even though they all have their own patients. And so there's a lot of issues to consider if you're advising medical practitioners in particular. So that's I guess. So do we have a question there? Is that
I'll deal with it. I'll deal with the question.
You'll deal with questions. I'll keep going. So I'll come back to that. We'll come back to that one. So then the second part of the slide is, and I think it's something you've got a bit of a familiarity with, Todd, as well in this summer, but it's the employer, again, as I said, payroll tax is such a huge area, but I've seen a presentation recently where someone was going through these employment agency rules in particular, and there's been some recent cases, this e-group security and integrated trolley management, which I understand provides services to Woolies, and someone was talking about cleaning. They were acting for a client who provides cleaning services to Woolies as well, and so they saw those industries based on these recent cases in particular, where the state revenue was going to look to essentially look at, and they look one thing that I thought was interesting is they look at the contractual terms, so between one of these service providers and say Woolies, and of course because it's Woolies, the contractual arrangements are going to be, the contract's going to be like this thick, and it's all going to be in favour of Woolies, and the comment was made that you might, the reality might be that take the trolley one, all the people out there collecting the trolleys, they have the company, as I understand it, has their own. These sort of companies have their own management. They are employees of this company. They or contractors perhaps of this company, whatever they are. Maybe contractors, not employees, but whatever. And this is the whole grey area in this. This is what the whole legal thing in this area that. Again, you might have some practical comments to make, Todd, from what you've seen in reality. But certainly, from what I understand of the theory, the comment that was made was that the commercial reality might be that they're reporting to management within their contracting company, but the contracting arrangement that's written, if you just look at the contract itself, is all in favour. All reads like Woolies are the ones sort of in charge and giving instructions, and so what in those sort of situations they will effectively treat the worker or the guy out there collecting the trolley as an employee of Woolies, but the contracting company will have the payroll tax liability. So do you want to add anything there, Todd, before I go any further?
So a little bit of background on integrated trolley management. They provide services and they manage the subcontractors and provide them with skills, education, and a structure to be able to provide the services. So it's a classic sort of services business via subcontractors. And they engage with their clients. They got hundreds of subcontractors. They manage all of that process. It was assessed as one of the areas that Revenue New South Wales wanted to look into. There was some commercial discussions, I understand, originally that didn't go anywhere because Revenue New South Wales really wanted to get clarity on this issue. In Supreme Court, first up, Revenue New South Wales lost, but then they won. It's a bit of a complex ruling, as you would have seen, in the Court of Appeal. So we've now subsequently been appointed administrator of integrated trolley management. We're working through that process now, but there is a material amount of money held to be able to pay the liability. The liability is greater than the amount held, mainly because, as you would be aware, there's no statute of limitation on payroll tax. So effectively, even though this issue was only raised 3 or 4 years ago, they're looking at going back well before that. So that creates uncertainty. So I think the big issue here is for Revenue New South Wales to provide some clarity around what their approach is going to be, so that businesses can actually consider this issue and then work out when it's going to apply and how they're going to deal with it. Because we're definitely aware of, from being this is a number of competitors have effectively gone into liquidation to avoid the liability, and because it's a largely services business, some of those would appear to be phoenixing as well. So you're not getting the revenue, you're not getting the opportunity to recover the revenue, but at least they now have a line in the sand where they can rely upon it and move forward. But I see this as a major developing issue because it's going to attract a lot of subcontractor arrangements, and it's going to become a material issue for a lot of large businesses they're going to have to deal with, particularly in New South Wales. The other implication is that now that New South Wales has this, all of the other revenue officers from around Australia are actually saying, well, it applies for us too. No, so I could see, and this is part of what I understand, is that it's a question of how far, what industries it does apply to, how far can this apply. I mean, one thing on the Woolies and the trolley thing is that I was thinking that what they, in really broad terms, I understand they're effectively treating them like let's say you're effectively working for Woolies, and I think it shows you I think how things have changed, because 35 years ago when I was working at Woolies, when I wasn't packing groceries, I was being sent out to collect trolleys. So that's just how they did it back then. But it doesn't work now, Peter. But that's right. So my trolley collection days are well behind me, and they that's right. They have the guys in high vis contracted to go and do this stuff. So it's just something that didn't exist previously, so hearing this presentation about these cases, and the security obviously was another one, and that I understand the security one, that was a bit of a structure. There's a bit of a structure that they had similar issue.
Had a similar issue, but they had a sort of an operating company and a contracting company within the structure, and that caused some. So they have these same sort of issues, and that got me thinking about a client that Rachel and I have, one of our significant clients of our firm that is in the construction sort of game, and they, certainly they have groups with different entities within their group, and had deal with a lot of contractors. So we've certainly had looked at various contracting issues for them and over the years and in different ways. And that one suggestion that had been made in that area is that if you've got licensing, it might be that the question is like, you don't need a license to collect trolleys. So I think Woolly I can attest to the fact that Woolies can employ people to collect trolleys, and they used to do that. But if you got in something like construction, there might be licensing things where they can't necessarily, unless they have those licenses. And I know actually our client does often look at that. It's quite key. They don't, if you don't have that license, you can't actually go out and employ people to do it internally. So you contract it out. So that may be a saving grace in those situations.
So the implications I look at it is you're going to increase your cost because your payroll tax is probably going to increase because you're going to have to include probably more parties. And the other implication is on wage underpayments and things like that, is making sure that all works together and hits through. And dealing with large corporates, they like these sort of structures because they can actually get people who have a regime and a corporate regime apply all of that to the subcontractors, so that the subcontractors are actually got better structures applied. So there is some logic to the way it's built. It's just going to cost more.
Yeah, that's right. Yeah, and I think, and the other, if my understanding is correct on this area, also the contractor exemptions. So where they're being subcontractors, some of these contractor exemptions that you would normally apply if Woolies or whoever the large business was engaging a particular contractor directly, there would be various exemptions they could apply. If they're going through one of these sort of talk about employment agent, I mean, it goes, and the point is it goes beyond what you consider to be a traditional employment agent to much other things. But if you're going through one of these agents, a lot of the contractor exemptions you would normally apply are not available. So that opens it up much more significantly too. So it's again very much an emerging issue, but one that seems to be potentially quite wide ranging. And the lawyer that I heard presenting was that we're talking about in that their firm has a couple of these cases potentially on the book. So they're poised to go to take some of these matters forward in court potentially.
Yeah. So let's answer the question now, because Tanya's giving me the wind up.
Yeah, good.
Would payments made to outsourcing, e.g. a seat in Philippines, be caught under the payroll tax provisions? I would have thought that you're engaging an entity to provide services over there, and I thought payroll tax is limited to Australia.
Yeah, I think unless you provide, I think the services have to be provided in Australia. I would have thought that would be my understanding. So I know that it can catch overseas entities, but I believe the people that are doing the work have to be here in order to be caught. So I think you'd be okay on that one. Okay. That gets into grouping, which I wasn't even going to talk about payroll tax grouping. That's a whole other area, but that's where that comes in.
Pete, you've managed to get me through an hour of talking about taxes and structuring and all those sort of things. I think you've done well.
So I think I had the easy bit. I think Donna's is the really complex stuff. Not the Rachel's is easy either. So I think we're probably done, aren't we? Yeah. So.
Do we have any more questions? Otherwise, I'll hand back to Tanya to send us on our way. And
thank you, Todd. I just wanted to thank all the speakers, Donna, Peter, Rachel, and of course your host, Todd. Thank you again for joining, and we'll see you next time. Our next HLB webinar will be in April, so watch this space. Thank you.